Today, we will talk about top 7 investment tips for beginners in 2023. After a bout of high inflation and the Federal Reserve rapidly raising interest rates, investors may still be reeling. Stocks spent most of last year in a downturn, even entering a bear market at one point. And with many top economists fearing a recession could be right around the corner, some investors may think there's no good place to invest. But extend your investing horizon, and 2023 could set you up for good returns later on. So what are the best investments for this year? The list below starts with safer picks and then moves on to those that should deliver higher returns but may be more volatile, giving you a healthy mix of growth and safety during what looks like a difficult market environment. 1. High-yield savings accounts. A high-yield online savings account pays you interest on your cash balance. And just like a savings account earning pennies at your brick-and-mortar bank, high-yield online savings accounts are accessible vehicles for your cash. Who are they good for? A savings account is a good vehicle for those who need to access cash in the near future. A high-yield savings account also works well for risk-averse investors who want to avoid the risk that they won't get their money back. 2. Money market funds. Money market mutual funds are an investment product, not to be confused with money market accounts, which are bank deposit accounts similar to savings accounts. When you invest in a money market fund, your money buys a collection of high-quality, short-term government, bank, or corporate debt. The money you may need soon that you're willing to expose to a little more market risk. Investors also use money market funds to hold a portion of their portfolio in a safer investment than stocks or as a holding pen for money earmarked for future investment. While money market funds are technically an investment, don't expect the higher returns and higher risk of other investments on this page. Money market fund growth is more akin to high-yield savings account yields. 3. Short-term certificates of deposit. Certificates of deposit, or CDs, are issued by banks and generally offer a higher interest rate than savings accounts. And short-term CDs may be better options when you expect rates to rise, allowing you to reinvest at higher rates when the CD matures. Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit. A CD works well for risk-averse investors, especially those who need money at a specific time and can tie up their cash in exchange for a bit more yield than they'd find on a savings account. 4. Series I bonds. The U.S. Treasury issues savings bonds for individual investors, and an increasingly popular option is the Series I bond. This bond helps build protection against inflation. It pays a base interest rate and then adds on a component based on the inflation rate. The result? If inflation rises, so does the payout. But the reverse is true. If inflation falls, so will the interest rate. The inflation adjustment resets every 6 months. Like other government-issued debt, Series I bonds are attractive for risk-averse investors who do not want to run any risk of default. These bonds are also a good option for investors who want to protect their investments against inflation. However, investors are limited to buying $10,000 in any single calendar year, though you can apply up to an additional $5,000 in your annual tax refund to the purchase of Series I bonds too. And there's a little-known secret to getting around that annual limit too. 5. Short-term corporate bond funds. Corporations sometimes raise money by issuing bonds to investors, and these can be packaged into bond funds that own bonds issued by potentially hundreds of corporations. Short-term bonds have an average maturity of 1 to 5 years, which makes them less susceptible to interest rate fluctuations than intermediate or long-term bonds. 6. Dividend stock funds. Dividends are portions of a company's profit that can be paid out to shareholders, usually on a quarterly basis. So dividend stocks are those stocks that offer a cash payout. And not all stocks do, while a fund packages up only dividend stocks into one easy-to-buy unit. Buying individual stocks, whether they pay dividends or not, is better suited for intermediate and advanced investors. But you can buy a group of them in a stock fund and reduce your risk. 7. Stay invested for the long term. Investing is a long-term game, and it's important to resist the temptation of frequent trading or reacting to short-term market fluctuations. Historically, The stock market has shown a consistent upward trend over extended periods. By staying invested for the long term, you allow your investments to benefit from compounding returns and minimize the impact of short-term market volatility. It's important to note that these tips provide general guidance, and every individual's financial situation and risk tolerance may vary. Consulting with a financial advisor can be beneficial in developing a personalized investment strategy that aligns with your specific goals and circumstances. Remember, investing involves risks, and it's important to conduct thorough research, seek professional advice when needed, and make informed decisions based on your individual circumstances. This is especially true in case of certain mutual funds, such as equity and balanced funds. Let us understand why professionals give such advice. What really happens in the long term? Is there a benefit to staying invested for the long term? What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.